I avoided paying the IRS over $80,000 in 2022. And yes, this was completely legal. There's nothing shady going on here. I just wanted to teach you guys some of the concepts that I'm using in order to help me pay $80,000 less in taxes in 2022 and help you guys realize that it's not that hard and that you guys can utilize the same strategy to help you save a lot of money on taxes in 2023. Now, I have to preface this by saying that I'm not a CPA, I am not a financial advisor. I am just a software engineer in the Bay Area who invests in real estate on the side, and I work with a tax strategist who helps me implement the tax strategies that I'm about to show you guys in order to help me pay a lot less money in taxes. So with that said, let's dive right in because we have a lot to talk about. So first, I'm just gonna give you a high-level overview of this strategy so that you can understand what steps need to be taken and what are the results of taking those steps. Secondly, I'm gonna dive a little bit deeper into each of those concepts so that you can understand how those concepts fit into this bigger picture. Lastly, we're gonna use all of these concepts and apply them to a hypothetical situation so that you can see how these concepts work together to help you save money on taxes. So before we dive into the high-level overview, there's just one concept that you need to understand, and that concept is called deductions. A deduction is simply a tax benefit given to businesses, and it's a benefit given to businesses in order to help them grow. So let's just start off with an example. Let's just say that you sell lemonade on the side of a room. Boom, there you go, you have a business. Now let's just say that you sold 20 cups of lemonade for $5 a cup. That means that your business made $100. But in order for your business to have made that $100, it had to first spend money to go buy cups, maybe a stand, maybe a pitcher, and those things cost money. So let's say in this example, those things cost $25. Now in your business, according to the IRS, you made a gross income of $100. But the IRS doesn't tax businesses based on gross income. Your business can claim those business expenses as deductions, which basically means that instead of reporting a gross income of $100 to the IRS, you can first deduct the cost of those business expenses from that $100 income and then report that adjusted number to the IRS, which is now $75. And we call that adjusted gross income. That is the number that the IRS taxes businesses on. So again, adjusted gross income basically means your gross income minus your business expenses that qualify as deductions. So long as the cost of those items are necessary and ordinary for your business, meaning they are required for your business, then you can claim them as deductions and reduce your adjusted gross income and therefore pay less taxes. So now that you understand the concept of a deduction, let's talk about the high-level overview of this strategy. So step one is to start a rental property business by buying a rental property. So let's just say you go out and buy a $500,000 rental property and you turn it into a long-term rental or a short-term rental. Second, you're going to buy a service called a cost segregation study, which is going to allow you to take about 20 to 30% of the purchase price of your home as a deduction in your business the very first year that you own it. So let's just say that we used 20% of the purchase price of your rental property, which is $100,000. Well, guess what? You get a $100,000 deduction in your business in the very first year that you own that rental property. Now, let's just say in that calendar year that you bought that rental property, you brought in about $30,000 of gross income. That's your rental income. So let's calculate the AGI or the adjusted gross income for your rental property business. You have $30,000 of gross income, but you have $100,000 of deductions. That means that your AGI for the calendar year that you bought that property is now negative $70,000. Now, last but not least, the most important step is to use that negative $70,000 of adjusted gross income from your business and carry it over to your personal tax return to lower your AGI from your W-2 job by $70,000. So how much money would you be saving in federal income tax if you reduced your AGI by $70,000? Well, if you're single and you make $300,000 a year, that means in federal income tax, you'd be paying $78,753 in federal income tax. Now, if you reduce your AGI by $70,000 from $300,000 down to $230,000, that means you'd be instead paying $54,253 in federal income tax. And that is a federal income tax savings of $24,500. So not only did you not pay taxes on the $30,000 that your property brought in, you are also saving about $24,500 in taxes that you are no longer paying to the IRS. So in summary, the goal is for your business to actually lose money on paper and to use the losses from your business and carry them over to your personal tax return, where you can use the losses from your business to lower the adjusted gross income that you report from your W-2 job. So let's unpack this strategy real quick because I'm sure you have a lot of questions. So first of all, what is a cost segregation and how does it generate a $100,000 loss from a $500,000 property? To understand cost segregation, you need to understand the king of all deductions called depreciation. The concept of depreciation means that your rental property is deteriorating over time, just like a car would. In a rental property business, the IRS treats depreciation as an expense against your rental property business. Since your rental property is losing value because your rental property is deteriorating, the IRS gives you a deduction equivalent to how much your rental property is deteriorating in value. So how can you calculate the depreciation of a rental property? To calculate depreciation, you basically take the purchase price of that property, which is comprised of the value of the land that that property sits on and the building itself, subtract the cost of the land, and you'll be left with the value of the building. Then you take that building value and divide it by 27.5 years. That is equivalent to how much of a depreciation deduction that you can take every single year for 27.5 years in your rental property business. So if you have a building that is worth $500,000 and you divide that by 27.5, you're looking at a deduction of $18,182 per year for the next 27.5 years as long as you hold on to that home. We call this straight line depreciation because you're taking the same amount of depreciation deduction every year for the next 27.5 years. Now, an $18,000 deduction is pretty good, but let me introduce you to depreciation on steroids. This concept is the reason why I'm saving $80,000 in federal income tax in 2022, and the concept is called bonus depreciation. Bonus depreciation is a tax incentive that allows you to front load the depreciation that you take in your rental property instead of taking a straight line approach. So rather than taking an $18,182 deduction every single year for the next 27.5 years, instead, if you use bonus depreciation, you can instead take perhaps a $100,000 deduction the very first year that you own that rental property, and then every year after that for the next 26.5 years, you would take a deduction of $15,000, $15,000, $15,000, $15,000, $15,000. So now let's tie it all back to the concept of a cost segregation study. Essentially, the cost segregation study allows you to assign a useful life to every single component that makes up your rental property. For example, the refrigerator is gonna have a useful life of 10 years, the flooring is gonna have a useful life of 15 years, and maybe the foundation has a useful life of 27.5 years. Bonus depreciation allows you to take a deduction for the full cost of every single component in your rental property business that has a useful life of 20 years or less. So essentially, the cost segregation study allows you to identify those components that have a useful life of 20 years or less and assigns them a value, and bonus depreciation allows you to take that value and take it as a deduction in your business the very first year that you place that property into service. And typically that cost segregation report will conclude that about 20% of the total building value can be depreciated in the very first year that you own it. So that's why if you buy a property with a $500,000 building value, you can get up to a $100,000 deduction in your rental property business. Okay, so with that covered, the second question that you might be asking is, how is it possible for me to take a $70,000 loss from my rental property business and deduct it against my personal tax return? For this question, the very first thing you need to understand is the concept of passive income versus non-passive income. So passive income is generated from passive businesses, and in this case, rental property businesses do qualify as passive businesses. Now on the flip side, your W-2 and 1099 income is considered non-passive. Now there's one big problem here, and the problem is that your rental property business is generating a $70,000 loss, but that loss is what we consider passive losses, and passive losses do not mix with non-passive income. It's like oil and water, they just won't mix. So for this last step, we need a way to mix oil and water, or in this case, passive losses from our rental property business against non-passive income from our W-2 jobs. So with that in mind, there are two possible strategies, and the first one is called the short-term rental loophole. With the short-term rental loophole, the strategy is to convert that rental property business that you have into a business that is non-passive. Instead of having a long-term tenant in place for this rental property, if you ran this property as a short-term rental and the average stay for all of the guests who stay in that property this calendar year is 7 days or less, you can claim this rental property as a non-passive activity or non-passive business. In that case, this rental property is generating not passive losses, but instead it's generating $70,000 of non-passive losses. And you can use non-passive losses to offset any of your other non-passive income. So that's why this is the #1 tax strategy for high W-2 income earning individuals. Now, the second option to use those losses against your non-passive income is to claim real estate professional status, or REP status for short. Real estate professional status is a special designation created by the IRS that offers a tax benefit for those who work in a real estate related field defined by the IRS, and they have to work in that field for 750 hours and more than any other job. And essentially, real estate professional status allows you to mix oil and water, meaning you can mix passive losses from a passive business with non-passive income. So with this option, you don't need to turn your business into a non-passive activity. You can just keep the rental as a long-term rental and just use the passive losses from that rental property to offset any non-passive income. So whether you're using the short-term rental loophole or the real estate professional status, they both allow you to do essentially the same thing, which is to take losses from your business and apply them directly against your AGI on your personal tax return, thus helping you pay less taxes on your W-2 income. Now, there is just one more requirement to be able to use these losses against your W-2 income, and that is what we call material participation. Material participation is when a taxpayer is involved in a business on a regular, continuous, and substantial basis. And really, there's 4 ways of proving material participation. So if you're single and you work a W-2 job, you're most likely going to opt for the short-term rental loophole because you're not going to be able to prove real estate professional status while you're working a full-time W-2 job. So for my wife and I, we actually claim real estate professional status on our joint tax return because she is a real estate professional and I am a W-2 employee. And so we buy rental properties and use the losses from our long-term rental properties to offset the income that I and my wife produce from our W-2 and 1099 income. So again, we use the real estate professional status and material participation, whereas most people might be using short-term rental and material participation to achieve the same effect. Now, for the sake of time, I haven't mentioned the one downside to this strategy, and that downside is called depreciation recapture. I've talked about that a lot in my last video, so you can watch that here. And if you want to use this strategy, I would highly recommend that you understand depreciation recapture before you move forward. So thank you guys so much for watching this far. If you guys made it this far, I hope you guys found a lot of value. This is exactly what my wife and I are doing to save about $80,000 of taxes in 2022. Now, the last question is, if you successfully implemented the short-term rental loophole and you reduced your AGI by $70,000 and saved about, let's say, $25,000 in taxes, the question is, what can you do with those tax savings? Perhaps you use those tax savings and you go buy another short-term rental next year and you do the exact same thing over and over and over again. Imagine saving $25,000 of tax-free money every single year. Imagine how fast your net worth would be growing compared to if you haven't been using this strategy. That's why I wanted to make this video, is because I wanted you guys to realize that as high-income individuals, you guys can pay a lot less taxes as long as you invest into the right assets and employ the right tax strategies. So thank you guys all so much for watching to the very end. If you guys want to schedule a one-on-one consultation with me, the link is in the description. If you guys want my personal tax strategist, just send me an email and I'll connect you with my tax strategist. Anyways, Thank you guys for watching and see you guys in the next one.